I see a whole bunch of people joining us, so thank you for joining us today on our webinar, Talking Technicals, with my good friend Adam Turnquist. I love these webinars. It just is a great way to just get a good key handle on where we are in the market, where we potentially might be going, looking at some areas and sectors that you may not be thinking about, and also just looking at maybe some potential tells in evidence that might be useful in your positioning, as well as the positioning if you're a tactical trader, positioning for the short term, and if you're more of a long-term investor, knowing where to just buy the dip and knowing how much capital to put at risk. Thank you, Adam, again for joining us. Just as some housekeeping items, the information that we're sharing today is just for informational purposes. It's so that you can get a good sense of what we're thinking and our capital, intellectual capital that we like to share. It's not in any way providing any advice of any kind. If you would like some personal advice, I'm always available. Please reach out to me. You can check out my website at www.stonewaterfinancial.com, and you can set up a time for us to speak personally. But a lot of what I do for individuals and high net worth individuals and ultra high net worth individuals, as well as small business owners, is craft portfolios to their specific needs, to their specific goals, to their buckets of when they need the money and what they're trying to plan for. So a lot of times I get asked the question, should I invest in Nvidia? Should I invest in cryptocurrency? And the truth is, it's very hard for me to answer that question off the cuff because I don't know your financial information. In order for me to really provide good, clean-cut advice, it really is important to understand your needs, goals, what kind of discretionary funds are available, and what are we planning for? Are we planning for the next 1 to 2 years? Are we planning for the next 5 to 7 years? Are we planning for succession in order to transfer wealth over to the next generation? There's a lot of key factors in planning, which do really help me decide what investment strategy is most appropriate for you. So my name is Stephen Bernstein. I'm president of Stonewater Financial. I have a wealth management practice in Century City. I work with high net worth individuals as well as ultra high net worth individuals and small business owners. I like to consider myself, someone who really tries to cater everything I do to a personal picture, to a personal individual situation. I like to know everything about my clients so that I can best help them. And I act as quarterback, working with their CPAs, their estate attorneys, and all of the people who really help them, even sometimes business managers, helping them navigate through the financial challenges and questions that they have on a daily basis, that they have to come up with a plan. I like being the quarterback because the more information I have, the more helpful I can help manage all expectations and also help them navigate those decisions when it's necessary. A perfect example is when you're dealing with your CPA, a lot of times you don't hand your financial information to them until close to when it's time to pay taxes. And usually that's already too late to make any real decisions and help you mitigate tax implications. So what I like to do is be involved throughout the year, looking at, are there some big ticket items that we're planning for? Are there big expenses? Are there big tax hits? Maybe you sold a company, maybe you bought a house, or maybe you got a big bonus. Whatever that is, a lot of times it's helpful to know that ahead of time before the end of the year so that we can plan accordingly and make those financial decisions to help ask your CPA whether or not we can use a specific strategy to mitigate those tax implications. One thing I do want to definitely, release and let you know about is every year I like to have some fun. I'm a big college basketball. I love the sport. I love basketball in general, but college ball to me is my favorite time of the year. And March Madness is just awesome. So I thought it would be fun for us to have a stock March Madness and create our own picks. Please feel free to click on the link below. You can scan the QR code and take you to a page where you can pick individual stocks. Adam, I'm going to ask to see yours as well because I want to see how I can, you and I can go head to head, toe to toe, and see who does better. This is more tactical, so you might have a little bit of an edge on me. But I'm sure it's going to be fun to spend time, pick the winners, and go through the process. With that, we've seen a lot of volatility so far this year. I'm sure we're going to see a lot more. There's a lot of challenges that we've spoken about last year in anticipation of this, that this year is a midterm election year. There is going to be a change of Federal Reserve. What we didn't know was that there was going to be an Iran war. There's a lot of different things, topics that come up that we have to just navigate through and understand whether or not it's short-term noise or a longer-term dislocation that might really have a longer-term effect on our money and our assets. So in investing, I think this year especially, we have to be very careful about where our overweights are and how much risk we're taking and whether or not the risk is worth the reward. No one has a crystal ball. No one can predict what's going to happen this year. But I think the most important thing is understanding the landscape. And if you can understand the landscape, you might be able to identify some really great areas that might be the next NVIDIAs, right? The next AI or quantum computing or whatever, that idea is. But those topics and whether or not you could pick the best of the best or the future growth can be huge. I like to call them the long shots. They're the long shots. You don't want to take a lot of your capital and put it to work, but those long shots really can pay off. So with that, let's look at markets. Let's see where we are today. Let's assess the damage. Let's see how we're currently positioned, and maybe we'll learn about some other areas that we might want to focus on. With that, Adam, it's all you. Thank you very much again for participating and being on the call.
Yeah, thanks for having me. My only request next time we do this, let's do it live in LA
Come
because
on down.
I spent about 5 hours snow blowing and shoveling over the last few days, and it's still cold here in the Midwest. So next
I won't
time,
tell
maybe we
you
can do
I
it.
won't tell you the weather here because I
Yeah,
definitely
I can
make you
imagine.
jealous.
I know it's better than here.
But we always have room for you, that's for sure.
Yeah, so we'll have to get that on the calendar for next time. But certainly happy to be here, especially in light of what's going on in markets and geopolitics. I feel like we're in mid-March right now, and we've already experienced a couple of years of price action. It seems like each new day is a new market. We're really headline driven with what's going on in the Middle East, and we're starting to see a little technical damage on the S&P 500. Stephen, you talked about navigating the landscape. We like to use technicals to help us, and we'll start with the popular and widely watched S&P 500 here. For the last several months, really going back to October, we've really been range bound. It's about all of this noise in the market, whether that's AI disruption, an AI bubble, and now this war breaking out in Iran. The market has just been stuck in this range, and resistance at the upper end of that range, about 7,000. The low end of the range, 67.75. And as you can see on the top right, bulls have started to lose their grip a little bit on this market. We broke to the downside of that range. Now, that doesn't mean the bull market is over by any means, but it does suggest we should expect further volatility and maybe a deeper pullback. We are coming into a major support level that we're watching on the S&P here, right at the 200-day moving average. That's a widely followed indicator for support. You can see on your screen right around 6,600. If we break that level, there's also the November lows. That's where you tend to see buyers come in when I'm talking about support. The November lows around 65.20. If we start breaking those two levels, the 200-day and the November lows, the conversation will change from the bull market narrative to are we entering a bear market? And I think it would not be surprising, especially that we're only a few points away to retest that 200-day moving average. I would be surprised if we break it and start rolling over again below those November lows. When you look at the market from a top-down view. You look at where the tech sector is, you look at earnings. I don't have any earnings charts, but the earnings story has remained intact despite all of the headlines we're seeing from the Middle East, despite oil going to 120. We're looking at another quarter of double-digit earnings growth for Q4. We expect the same cadence in growth for the S&P throughout this year. So earnings are holding up very well. We haven't had a lot of negative revisions this month already when we look at what analysts are pricing in. So the fundamental story still solid. You look at the economy, still solid. We expect GDP growth around 2.7%. Of course, there's risk those numbers come down if oil stays higher for longer. But the fundamental macro backdrop, a little more complicated, but still, I think, on solid footing for this market. We did break below the December lows, and that was at 67.21 on the S&P 500. Now, there's an indicator. Technicians have an indicator for just about everything, and this one I put a little more weight on, just given its history and it's widely followed. And what it means is when the S&P breaks below its December low in the first quarter, it's usually a pretty ominous sign for full year returns. And you can see how those returns stack up when the indicator is triggered. Average return for the S&P, this is over the last 75 years, is only 0.6% and higher 55% of the time. Now, you compare that to the average return for the S&P over that same period. The annual return just on a price basis is about 9.3% and higher just over 70% of the time. So very below average positivity rate and below average returns. When you hold above the December low, a much different story. We're not talking about that now because this has already been triggered. But you also have to have some context here. Whenever you look at seasonal data, context is key. We have somewhat of a binary event in the Middle East, elevated geopolitical risk, the potential that cools down. We have an off ramp in the US, the Strait of Hormuz opens, then this indicator I think would take on a lot less meaning. Last year was a really great example that history doesn't always repeat. We had similar events with elevated geopolitical risk, the tariffs. We did get a negative reading or a negative signal on the December lows indicator, and the market did very well last year. So that context was really key when you think about the seasonal data, and I think really the same applies today.
I think a lot of people forget that every year the S&P has a drawdown.
Right.
And sometimes it's bigger than others, right? Like the typical drawdown is anywhere between what, 10 and 15% on an annual basis. More than that happens, but very rarely. I think when you're invested and you see the end of the year and every year you see the last 4 years have been so positive, it's very hard to remember those triggers and those short-term, disparities where you actually see that downturn. It's keeping invested, staying invested, and making sure you have a plan is always the key in order to really win. And that's sometimes people get scared out of a trade or scared out of the market, and when they do that, they lose out on that one or two or even five best days of the year that really could make a big difference.
Right. And there's definitely a lot of fear in the market. And trading around these geopolitical events is pretty tough. It's hard enough to even come up with a time frame of what an exit plan would look like or when the Strait of Hormuz is going to open. So sticking to the trend and following it, I think, is really key. Having an advisor is key to maybe walk back and provide some context around that fear.
Yeah. I mean, you can always ask ChatGPT and they may end up having a great answer, but what's the feed of that information? How are they getting to provide you with that advice? And you have to really think about that, because if you're not asking the right questions, you're not going to get the right results. So it really is about asking the right questions and making sure you understand where we are in the cycle in order to really navigate through these challenging times.
Right. And certainly challenging could be underlined right now with, with what's going on. We look at the market, we talked about price action and kind of where the S&P has been, where it might go. And then we also look at market breadth. And this is just a measure of how many stocks are participating in a rally. You want broad breadth. So a lot of stocks trading in uptrends above their 200-day moving average for a sustainable, durable bull market. And when those internals, market breadth, start to deteriorate, it's often a warning sign for the index level to start experiencing some weakness. You can look at our trend model that we have here. I won't go through the metrics behind it, but the more green on your screen, the more uptrends, the more red, the more downtrends. And we look at the entire S&P 500 here, and there's a few things to call out. We have now switched over to a market that has more downtrends than uptrends. That's been the first time we've seen that really since last fall. So there's a growing number of stocks entering downtrends. And then it's important to look at the composition of those trends and what sectors are experiencing the largest percentage of confirmed downtrends. And you can see kind of in the table that we have on the bottom left, you have consumer discretionary, tech, financials, and consumer or communication services leading the way in terms of the most stocks in confirmed downtrends. That's not the leadership you want to see when you're at these inflection points in the market and when you're trying to find your footing. It's a bit concerning on a technical level. Doesn't mean, again, that the bull market is over, but it does mean we'll need to see a broadening out in some participation here in areas like tech, consumer discretionary, especially financials, when you think of them as a barometer for the bull market. You typically don't have a strong bull market without financials. And then the bank's obviously a proxy for the overall economy. When you think about lending and default rates and everything that goes into the banking space.
One thing to consider is that the last 4 years, Mag 7 have really been the driver, right? We haven't seen a broadening out of other sectors and other stocks that really have done well. The majority of it came from Mag 7, especially last year. And what's nice about this year is that it is broadening out to other areas. I agree that it's we have to be careful. In order to have a continuous bull market, you do need participation with financials. You need participation with technology. But what's nice to see is that there is a shift in money going away from some of your large cap Mag 7 into other stocks that have not really participated in the last couple of years.
Right. And that's a really important point as well. And it's not money leaving the market, right? It's rotating. Money is staying inside the stock market. It's just going from the heavyweight mega cap names to areas like industrials, materials, energy, even some consumer staples earlier this year. So that's important. We're not seeing a flight
Yeah.
of capital move out of equity markets. And I think that's a good sign for markets right now that maybe we will hold up here.
Another thing to consider is that a lot of people were positioned in very conservatively in the last couple of years, not really participating in that growth. When you can get 5% in treasuries, that's a no-brainer, right? You're getting 5% in treasuries. It's a safe haven. It's really not much risk, and there's quite a decent reward. I think that's changed. And now you're seeing treasuries much lower in the threes, so it's not as exciting. And that's hopefully where we'll start seeing these dry paint, this dry, powder money start to flow back into equities and to be a little bit more growth oriented. But we need less bad news in order for that to happen.
Right. It's a lot for the market to digest right now when you look at whether that's monetary policy, inflation, labor, geopolitics, AI. There's been a lot thrown at the market, so not surprising we've seen this pullback in the market. We're only call it 5-6% away from a record high though, and I think that's another important factor. Look, there's
100%.
a lot of negative news out there, but stocks, considering what they're going through, are holding up relatively well. This is just highlighting how this year, really to kick off this year, we've had this big rotation where investors moved out of some of those concentrated positions in those mega cap names, and they were moving into some cyclical areas, like we'll call it materials. Industrials have had a good run here, and then also some more defensive areas, which is a little bit concerning when you think about risk appetite in the market. But the year-to-date return dispersion, very, very wide, and there's still more stocks in the index that are up over 20% this year than down 20%. You can see that there's quite a bit of green there, or dark green. Those are all the stocks in the index up over 20%. And those stocks, unfortunately for the S&P, are not the heavyweights, right? I think the next slide is a really clear picture of how the S&P 500 has a weight problem, as we call it, because this is showing each sector across the S&P 500, every stock within that sector, the year-to-date performance, and the size of each dot is representative of the weight within the index. So you can see those big dots, whether it's tech, comm services, and consumer discretionary. Those are the mega cap names, right? That we're familiar with, the Meg Sevens, the Amazon, Nvidia, Microsoft, Alphabet of the world. And they're basically all below the zero line. So in negative territory year to date. You look to the right at areas like energy, staples, utilities, industrials, even. There's a lot of little dots well above the zero line. And if you take the top 5 stocks in terms of their weight within the S&P 500, that's 25% weighting in the index. To offset that weakness, you need industrials, staples, energy, utilities, materials, and real estate collectively. So 6 sectors to offset 5 names in the S&P 500. And that's this consolidation phase that we've seen this year. You've had these smaller weighted names do really, really well and provided that counterbalance to the mega cap weakness. Now, some of those are overbought, probably due for a little bit of a pullback. Will we see a rebound in the mega caps? I think that's going to be the next narrative as we work our way through this, we'll call it war or crisis in Iran.
I love this slide because, portfolio managers don't really outperform, don't beat the benchmarks, right? They don't beat their benchmarks for the most part. But now we're in a stock pickers market where if you have the right sauce, you really do well. So I would expect a lot of portfolio managers this year to really do well if they have the right free cash flow companies and priced the right way, that they're still growing and they're not going to get hurt by those high flyers that, the valuations just don't make any sense.
And we'll get into the tech sector as well as we progress into the presentation, but we often call it a pain trade where the institutional side is underweight an area that starts to work, and they're very underweight big tech right now. They deleveraged out of big tech and more or less chase this value trade that's been playing out. Now, if that narrative shifts, which it often does when the pain trade is apparent, you could see a rebound in big tech, and then this market start to work higher, and then people will start chasing that trade, or capital will start chasing that trade, and I think the narrative could once again change.
And you definitely don't want to have FOMO when the market starts to take off.
Right? It's usually too late at times.
So
Um,
now we're transitioning to the VIX, and I follow the VIX on a daily basis. I think it's very important to see the volatility. Usually, when there's a huge spike in the VIX, that's a good sign of potential bottoming of the market. And we've seen the VIX go north of 35, if I'm right.
right. Yep. So Monday morning last week, early Sunday night when the futures opened, the VIX shot up to 35 and change. You can see that red bar on kind of on the far right. Since then, though, we've backed off considerably in the VIX. We moved back below support around 29. That goes back to the October highs. And that's a good sign in itself, but the VIX futures curve is another measure of fear in the market, right? So if you're an investor and you want to hedge your downside, you move to the front month VIX futures and you buy. And that's really what you see here. That's the underpinning of that move to 35. You're willing to pay a premium over longer dated contracts. So there's this surge of buying that goes into the front month that creates a premium. It's called backwardation. That only happens about 20% of the time, and it usually overlaps with peak panic in the market. And when you move from what backwardation, again, where the spot or the front month VIX trades at a premium to longer dated contracts, and the VIX curve normalizes and goes to contango, its normal upward sloping shape. That's usually a sign we're past peak fear. It doesn't mean that volatility is going to recede back to its average or even below average type levels, but it typically means we've seen the high when you go from backwardation to contango. And today we actually saw that. I didn't check the futures curve before the call here, but As of about 3 o'clock Eastern, we were back in the normal upward sloping shape. So what does that all mean? We probably are at or near peak fear at this stage. And we talked about the VIX intraday high going to 35. Well, we know a high VIX tends to mean that the market might be close to a capitulation point. We tried to quantify what high VIX really means and what are the implications for the broader market. So we went back to the early 90s and we back tested all of the VIX intraday highs and then we ranked them by decile. So the highest readings to the lowest readings in the VIX, top decile to get to that level, you need a VIX intraday high above 30. And then we ran how does the market perform after crossing that threshold? And you can see here across 1, 3, 6, and 12 months, the S&P does quite well when you stack it up against the other groups, well above average return. So I think at this stage, at least with the VIX, we can check the box for a potential capitulation in stocks. It doesn't feel like it today when we had the S&P going out on the lows today, right near the 200-day moving average. But using this as an indicator, I think maybe we're close to some type of capitulation.
even if it's short term.
Right, even if it's short term. And we shouldn't be too surprised by the degree of volatility and choppiness in the market. When you think about midterm election years that we're obviously in right now, they are the most volatile in terms of the presidential cycle, and they're very choppy. Here's the S&P, how it typically progresses during a midterm year. You trade lower in the first couple months. There's some choppiness throughout the year. The lows generally registered kind of in May or the September, October timeframe. And then when there's clarity around the potential outcome of midterms, that's when the market does well. You remove the cloud of uncertainty. As we know as investors, the market hates uncertainty. And I think this chart really depicts that trend pretty well when you look at how the S&P performs really right after midterm elections, right around that 211-day mark of the S&P, you get above average type returns. So expect more volatility, expect more choppiness. And for investors, that's an opportunity. As you mentioned, Stephen, it is a stock picker's market. And I think this chart really outlines that well.
Yeah. Let's get into I think I went to the wrong one. There we go. Oil prices. Um,
Yeah.
so right now, oil actually has gone up as far as $120 a barrel, which is pretty wild, especially when we were at like 40 like last year. What's interesting is that obviously it had a lot to do with the war and the Strait of Hormuz and being closed down. So I think a lot of people don't realize that the U.S. is actually a net exporter of oil and natural gas, and we actually have make a lot more profitability on exporting it these days. And so the higher the price, even though we don't like it at the pump and it hurts us, in our pocketbooks, and now it affects our spending habits, we do end up making significantly more revenue because of it. So it's not a great thing, but the question is, how will it impact GDP and how will it impact, is this something that's going to be higher for longer? Will we see oil prices above 90, above 100 for a longer period of time? That is like a resurgence of that will end up as a resurgence of inflation for sure. But the question is, are there other areas of profitability that might offset that?
Right. And that's the $1 million question, the higher for longer part of that. And that's what the market's trying to figure out right now with this rally in oil, with the Strait of Hormuz. Extremely important. It's the biggest choke point for oil around the globe. 20% of global oil moves through the strait. And the fact that it's shut down right now is creating this supply shock. And other producers in the Middle East are now shutting down the refineries and production because they basically have nowhere to put the oil because they can't export it anymore. And that's really impactful for countries that are reliant on Middle Eastern oil, areas like Japan, Thailand, the Philippines, China, another big one, um, India, another big one. So they're experiencing even more pressure right now because they don't have access to their normal supply route for oil. The US, as you mentioned, is a net exporter, so a little bit more immune to the supply shock, but not on the economic side when you talk about gas prices at 2-year highs right now and just the inflationary pressure that's building. And it's not just oil, there's other products that flow through the Strait of Hormuz. Fertilizers is a big one that's playing out in the agricultural space. So about a third of fertilizer flows through the Strait of Hormuz. That's effectively closed. That's putting upward pressure on things like wheat, soybeans, and corn. That when planting season comes up here, especially in the Midwest, and there's no fertilizer, that creates lower yields in terms of crops and then the potential for a shortage. So there's all of these ancillary effects that trickle down from the strait being closed. Now, the silver lining to all that, it puts a lot of pressure on the administration to reopen the Strait of Hormuz and at least outline an off ramp. We don't know what those are going to look like and when. I think as we get clarity around that and clarity around the potential of reopening the strait, oil will likely back off here. I don't think it immediately moves back to, a five handle that it was at coming into the year, but it will certainly help the market. It will certainly help the Fed. As we heard today, they have no clue what the inflationary impacts are because they don't know how long this is going to last. For now, the Fed today revised their inflation forecast higher, but they also revised their growth forecasts higher and still have one rate cut penciled in. A lot of those decisions, a lot of the market decisions are reliant on oil right now and what the next step is for oil markets. It's certainly in the driver's seat. And we go back to the technicals here. If you go back to the oil chart, things that we're watching on a technical level for oil to get back down below 95 or even kind of the 78, $80 range for WTI would be a step in the right direction, of course. But we're also watching implied volatility in oil. And you can see on the bottom panel, that's basically the VIX for the oil market. And that's extremely high right now. It is not really backed off in the same way the VIX is backed off or even WTI prices. And that has been the persistence of that being high really speaks to the uncertainty surrounding the Middle East. And really, for the market, it's telling us expect higher volatility. There's still upside risk in oil. We don't have a forecast in oil. I think technically you can make the case maybe the highs were made that Sunday night when the futures opened up, but certainly hard to make the case right now that oil is going to move immediately lower.
I think poly markets are betting that the war is going to be longer, not shorter. And poly market, I think the percentage I saw was about 90%, which was pretty high. And then the poly markets also are predicting that oil will remain higher for longer as well. So those are two not good things. Both of those are
Right.
actually going to hurt us, which I don't know if I agree with poly markets. I guess we'll wait and see. I'm hoping that there is a Trump put where we either end the war sooner than later, or we release barrels of oil into the market, and which would allow us to like lower gas prices as well.
Right. And the Brent futures market aligns with the poly market assessment of the how long this will last. We look at where the futures market is pricing in longer dated Brent contracts, and what's really stood out over the last month, or I guess 3 weeks as this war's been going on, is the longer dated contracts continue to go up in price, meaning the market is pricing in higher for longer oil prices and not this immediate kind of near term supply shock. At least according to the futures market and what they're putting their money where their mouth is that this is longer or higher oil is going to be probably a longer term story unless we get some immediate action here, because even to reopen the strait and get production back to where it was, it's going to take time. And the longer this drags on, the more damage as well that's being um, incurred across a lot of the production in the Middle East, as well as having a big impact on overall the overall picture for the oil market.
Yeah, I mean, the good thing is that you can see here that the oil is actually tracking the Russian invasion in Ukraine. So oil prices came up then as well, and it looks like we're probably going to go sideways for quite some time before we start coming back down. This is not necessarily how it's going to end up, but it's a good tell of or predictability of what we potentially could see. And what's what's interesting, a lot of people don't know is that geopolitically, we've seen a lot of events and crises over the years, and typically they actually spur a lot of growth. Markets actually are pretty resilient and actually do well during times of war, and you can see that in this chart over here.
Right. And we're kind of near the average drawdown when you look at all these major geopolitical events, as serious as they are from a market's perspective. It often goes back to the fundamentals. What's the economy doing? What's corporate America doing? And I think, as I mentioned earlier, that story is still holding up. Average drawdown about 5%. It takes, on average, 39 days to recover. And then you can see on the bottom right there, the average 12-month return after all of these major events took place, you're higher by almost 8%. And some of the big drawdown years that are in this are really more related to recessionary environments. And of course, we're not in one. At least we don't believe we're in one right now. So I think the fact that the fundamentals are still holding up is really key here to add some context to this chart and does not suggest that major geopolitical events are catalysts for the economy to move into a recession and for stocks to trade lower.
So let's move into AI. The real question is has that going to disrupt every sector? Is that going to disrupt so many jobs where people are going to be out of work and now suddenly, similar to like the software sector, we're going to see some significant downturns? Or is it more of like a tool where AI is going to create new jobs, similar to what we saw in the dot-com time frame, where we had a lot of new it was new to us. We didn't really understand. It displaced some jobs, but at the end of the day, it created a lot more new ones.
Right, and that's the big question as well. It seems like it was a year ago when we were talking about AI disruption, given the recent events in the Middle East, but certainly an important topic for the market and another area that I guess from a market's perspective is unresolved with the assessment of the damage to AI versus what's really beneficial. The tech sector telling us as of right now it's not a major disruptor or displacement for some of the software names. Tech sector technically is holding up right at these key support levels. It was very oversold going into the 200-day moving average. Just recently, we've seen inflows into the tech sector. Maybe it's more safe haven related buying and some of these names that generate a lot of free cash flow. They've got earnings growth with or without oil prices at 120. And it's held up really well. And this is a chart I watch throughout the day, especially given where it's at right near this major support level. If we start breaking down in tech, that's going to be your sign that the broader market, the S&P 500, is probably going to follow suit, and we're going to see some downward pressure. But the fact that tech's holding up here, a pretty good sign overall, I think, not just for we'll call it the S&P 500, but even on the AI story as well.
And remember, even if it does break down, you want to participate in the market because you'll never be able to predict that exact day when things turn around. Things can turn around so quickly that if you start to really make some big, significant shifts within your portfolio, you'll never catch up. So, having a plan, making sure you're invested appropriately, that's key, 100% of the time.
Right. Another positive sign, I think, not only for the tech sector, but for the economy is just the semiconductor space. You can see here we're not far from record high territory. This looks like a pretty routine pullback from some shorter term overbought levels. The trend clearly up and to the right. We haven't had a lot of internal damage, a lot of the semiconductor names holding above their 200-day moving average. And it's also leading the market. When you look at the semiconductor index, you compare it to the software index or the S&P 500. As such, on the bottom panel, it's been up and to the right. So semiconductors often considered or widely considered, I should say, a leading economic indicator when you think about how many semiconductors we use in our daily life. The fact that semis are holding up, the AI story is holding up when you look at spending trends as well. And even the other side of that, software basically obliterated here over the last several months with fear over AI disrupting some of these legacy software names. The bear case there is, look, you can use Anthropic or OpenAI or Google large language models to basically replicate, whether it's your CRM or any of your enterprise software, and you can just build it yourself. You don't need these expensive subscriptions. And the market, I think, discounted that to that trade severely, maybe a little bit overblown. You can see the software index here all the way back to the April lows, a very important support level. That's where buyers came in. There was valuation support on the bottom panel. It's the one of the valuation metrics we look at for software, enterprise value versus sales. And we were at bear market lows in terms of valuations. And that's where buyers came in as well. It lined up right where that support level was. We've had a pretty significant bounce here. I wouldn't call it the all clear here, but certainly an area ripe for the stock picker that can go in and look at these names, see how entangled they are in terms of their software, where it sits on the stack for corporate America, how ingrained they are. And I think that's what you're seeing in the software space right now.
What's interesting is, so a client of mine called me up and actually told me that he had a pet project that he's working on where he needed a contact database similar to like a Salesforce where he can be able to track, his clients and what goes on and be able to, but he wanted to he wanted to create it in a way that was most useful to his company. So he went on chat and used a couple of other AI programs in order to create one. At the end of the day, it gave him the code to create it, but he needed to hire a programmer to actually put it together. So don't think that software is completely dead. It's not. There's a lot of need for the programmers in order to get it to where you need it to be. You may be able to have the code, you may be able to have chat create something that's usable, but at the end of the day, you're still going to need to know how to use it and actually apply it. And I think that's very important.
Right. And manage it, right? You look at a company like Salesforce, they're the largest, I think, customer relationship management software company in the world. And they're deeply integrated into the Fortune 500 companies, right? A lot of people use Salesforce. They have all the data and they're actually leveraging AI. They've opened it up to, I believe, Anthropic and Google and allowing their users or customers to create their own agents to customize their CRM model. So it's not displacing them. They're really leveraging the technology to create a better product. They have what's called Agentforce 360. It's rapidly growing within Salesforce. Of course, this isn't a recommendation. It's just an example where the market is pricing in displacement. In reality, it's really leveraging and enabling a company like Salesforce to create a better, more bespoke product for each customer.
Yeah. And they remember they have the client base. So they have the client base and they can always utilize AI better than we can because they already are familiar with how it's supposed to work. So I think it may be fragmented at this point in time, but I think there's going to be a lot of these like growing pains with AI where you're going to see some innovation, a little bit of scare and panic selling, and then we'll start going back to like normal. And I think you can see that in software for sure. What's interesting about software and Bitcoin is that they've been very closely related in how their performance has acted, right?
Right. It's been incredible when you look at this chart. I had to make sure I had it correctly in my Bloomberg when I pulled up the initial correlation here. We're looking at the North American Tech Software Index in black and then Bitcoin in blue, and it looks almost identical, right? You can see the trends are the same, the inflection points are nearly the same. And what stands out when you're thinking about identifying a potential bottom in software, and of course, the same question is present right now in Bitcoin. Have we bottomed? What you'll notice in the details here, software often leads at these major inflection points by either a couple weeks or a couple months. You get these turns, whether that's at the peak or at the trough. You can see where the software index peaked out or bottomed. It typically happens a little bit before Bitcoin. And if you make the case that software is maybe bottoming, I think if you're a Bitcoin investor, that's a good sign for a potential bottom here in Bitcoin. But it really, for Bitcoin, we view it as really a barometer for risk. and risk appetite in the market. And you can see when Bitcoin started to roll over and break its trend, that's when the market started to struggle. There was less risk appetite playing out, not only obviously in Bitcoin, but other sectors as well. So we like to monitor it more for that aspect than a long-term investment vehicle, I guess we'll call it.
Right. Well, they've been a leading indicator, right? And what we have seen is Ethereum specifically has actually bottomed out, or looks like it's bottomed out, and it has had quite a little decent rally for the last couple of weeks. So, I don't know. You don't know. It's possible that we may see an inflection point here where the market completely goes growth and moves out of value again. But overall, I think it's interesting to see that Ethereum and more assets are starting to perform.
Right.
And CapEx. I mean, it's interesting. You go back a couple, a year and a half ago, and the free cash flow of your Mag 7 was significant, and they had so much cash on hand. And now you're seeing like a lot of debt being raised in order to keep up with AI. Actually, the only company that is not raising debt is pretty much Apple, and their spending has actually come down from last year. But your Microsoft, your Facebook, your Google, all of them are spending billions of dollars, hundreds of billions of dollars in order to stay on top of AI and incorporate it in what they do.
Right. It's an AI arms race for sure. These spending numbers, you can refresh this almost daily and they go up. When we put this together with 600 billion, now you're seeing some estimates 700 billion. I've seen the trillion number thrown out there for kind of 2028, 20, I think even some people are in the 2027 camp. You listen to Jensen Huang, the CEO of NVIDIA, which is really the epicenter of AI right now in data centers. And they're looking at order flow in the trillions for some of their new chips by next year. It's just an insatiable amount of demand going into the data center build outs. There's so much compute power that we need as well. So it's not just the hyperscalers and the data center. You have to think about call it the picks and shovels that are building them. They've been a beneficiary as well. You have to get things like copper, for example, is a big component within the electrical system, and that's the underlying metal has done quite well, at least up until the last couple of weeks, where we've had a little bit of selling pressure. But there's some ancillary plays there as well. Here's the data center and electrical equipment basket. This one's from Goldman Sachs. So these are companies that are tied to data centers and that electrical equipment. And you can see the trend here. You don't need to be a technician or have a CMT at the end of your name to understand this has been a pretty strong trend. It doesn't really show signs of slowing down. The spending side, even though there's a lot of talk about an AI bubble, we're hearing from the companies that are writing checks, they're not slowing down as well. And they really can't, because they're going to lose market share if they don't spend and build out their data centers and supply power as well. That's why you're seeing some power contracts, long contracts, where companies are committing to buying X amount of power, even though they might not need it, because they're worried they're not going to have that power in the future, just given some of the trends that we're seeing. Here you can see just power demand across the globe, and it looks like the hyperscaler spending chart, right? It's exponential growth here from power data centers. You can see the US in blue, China, another one in red there. They're the majority of the overall demand. What I guess surprises me a little bit is just the how do we or what's the source of that power? And we're still looking at really coal and gas, we'll call it, powering demand. I think nuclear could be an interesting one, especially some of the smaller nuclear modules that are being built, and in the guess we'll call it red tape being removed on some of the nuclear facilities. They're restarting or expected to restart some facilities. I think on a near-term basis over the next several years, we'll call it, when you look at this cycle, nuclear could be an integral part of powering AI. And there's some interesting nuclear plays, not only in the energy space, but when you look at what goes into nuclear, you have enriched uranium that we source from Russia. That's being reconfigured, the supply chain that is, as the U.S. wants to be less reliant on Russian enriched uranium. So the companies that are actually extracting enriched or uranium from the earth could be another beneficiary here.
Definitely. And productivity picks up, right? So labor market, productivity will come back. That's what happens. We have it's typical growth. Right now, unemployment is at a historical low still. We've had a little bit of an uptick in the technology sector of some jobs that have been lost, but new jobs will be created. That's the cycle. You know, it happens over and over again.
Right. And it's really a show me story, I think, for 2026 in AI. Last year, it was really about how much you're spending. And you could go to the market and say, look, I'm going to spend $100 billion this quarter on AI. The market rewards you for that. That narrative has now changed because the introduction of a lot of debt among the hyperscalers. So they're going to the debt market. They've gone through their free cash flow to really to build out all of this AI infrastructure. And so it's not only what's the quality of that spending, what's the return on investment, what's the productivity we're going to see from an economic standpoint. And I think right now the trend is in the right direction. You can see the blue line, that's output per worker and hours worked less. So when you're more productive, that's not only good for the bottom line and earnings, but it's also good for inflation. We even heard Chair Powell address a question today about what's the impact AI could have on productivity. I would call it maybe not a bullish response, but a positive response from even the top of the Fed. So we'll continue to monitor these trends to see if the productivity really shows up. But for now, the evidence that we see, it's certainly playing out in the economy, not just in the individual equity story.
Let's get into the dollar. We'll have to speed up a little bit, but you know, we'll get into the dollar and then Trumponomics and all the fun stuff that comes with that.
So this is another chart we're watching very closely. You can see we've just been range bound in the dollar for the last almost for the last year, kind of around 96 to 100. We're at a very important spot though, with the dollar just below 100.5. If we break out of that range, that would suggest further upside in the dollar. That's generally a headwind for international markets. So if you have international exposure here and you start to see the dollar breaking out, that could create some problems, especially for emerging markets. We're not there quite yet. So this is one that we're watching carefully for any type of breakout. You can
Right.
see how many people, and by people I mean speculators or managed money, call it hedge funds, were short the dollar going into this year. Those shorts have largely been covered in that middle panel. We're now basically turning to more of a net long position among those speculators as more and more people chase the higher dollar story. So some of the rally's been short covering. Of course, some of it's been safe haven flows as the market sold off. And then also just the reduction in Fed rate cut expectations that's put upward pressure on the dollar.
Yeah, Israel's been in a war for quite some time, and their currency has actually done really well, and their GDP has been growing. So, war, even though it's not something you want to be in, it does actually it help the economy in certain ways, and it also usually the market does perform decently over that time. So hopefully the dollar will start bouncing back up in light of the recent war that we're in.
Right. And from the market's perspective, a stable dollar is usually kind of the best case scenario. Big moves up and down tend to create volatility in equity markets and fixed income markets. So maybe that range bound type of dollar that we've witnessed over the last year is a hopeful example. But when we look at the dollar now, we compare it to Trump's first term. So from election day throughout 2017, it's tracking very, very closely to the dollar from back then. We'll call it Trump 1.0. Not only the peak we had coming out of the election this year, nearly the same magnitude, but the drawdown here as well. And we're now, as you can see, 2017, the dollar continued to appreciate. But when you use these analogs, as I highlighted before, you got to have some context. And that was when the Fed was raising interest rates, not the
Right.
same economic backdrop, certainly not the same macro backdrop, especially with what's going on in Iran right now. But I do look at this chart and I wonder if we're going to continue to track the Trump 1.0 dollar. I've been surprised of how closely this is followed, just given the complete opposite macro environment that we're in. But here we are, and we're right at kind of the same path of 2017.
And there's no alternative to the dollar, not right now.
Right, and this is a question we've got throughout last year, probably one of the top questions because the dollar sold off hard in 2025. It was the worst first half of the dollar index going back to its inception. There was a lot of fear over the dollar losing its reserve status. So the globe transacts in dollars, and the world's financial market is here in the US. And we've long made the case there's really no alternative to the dollar. And we brought some charts to kind of support that thesis. You look at overall currency usage on the left table here, and that's the US obviously on the far left, and 65% we'll call it is based in the dollar. So that's the role of the US dollar, its share of global GDP and share of global trade. And you stack that up against China or even the European Union, and it's really not even close in terms of its actual usage. So there really is no dollar alternative. You can see it even more clearly when you look at export invoicing. So think of just global trade. Nearly all of it is done in the dollar. The collective Asia Pacific region is second closest. Nearly 80% of that is done in the dollar. You look at our liquidity in U.S. markets, and there's no alternative there. So it's tough to make the case that the dollar is going away in terms of its reserve status. There's some diversifying away from the dollar among central banks, and that's really the what's played out over the last couple of years is central banks have been buying gold instead of the dollar, but they're not completely eliminating the dollar from their reserves.
Yeah. It's also interesting to note how hyperbolic the gold has actually gone. I mean, it's gone off the charts and it's gone up really, really quickly. It's sort of like a growth asset when you think about how fast it's gone up in the last, like, let's call it year, especially this year to date. Overall, what are your thoughts on gold moving forward? I think that gold is actually becoming a leading indicator to growth assets also, where potentially we may see a change in gold where we might see it coming back down. And if that's the case, I could see market continuing to rise. But gold has historically been that safe haven. So do you believe that today it's still a safe haven, or is it more of like an asset class?
Still a safe haven, I would say, subject to some risk, we'll call it, just given where it's trading. And it got wrapped up into this momentum trade last year, late last year especially. You can see kind of this parabolic move. A massive amount of capital flowed in via ETFs and this fear of missing out trade in gold. So now we'll call it in the corrective phase of that. That typically, when we've seen the similar analogs, it takes, call it 40 to 90 trading days for that to resolve itself. You can see those blue kind of half circles that are highlighted there. Those are periods where gold experienced similar overbought conditions. It consolidates and then breaks out. The long-term trend, hard to argue with here, clearly up and to the right. I think that continues. We've been positive on precious metals for probably 2 years now. Fundamentally, when you look at gold and the drivers of gold, probably number one is central bank buying. Really, since Russia invaded Ukraine in 2022, the US seized around $300 billion of Russian dollar assets. And that was a wake up call for other central banks to maybe diversify away from the dollar, because if they do something the US doesn't like, they can freeze their assets and it's a big risk. So since then, central banks have been buying gold in their reserves about 4 times the annual amount. And gold is now the second largest reserve asset across global central banks. It actually surpassed the euro, it surpassed treasuries. So you have the dollar at 56% of reserve assets are held in the dollar among other global central banks. In gold, depending on where you mark it, it's maybe around 35 to 40%. The euro, the second or most held currency, is only at 20%, to give you some context there. So a massive amount of buying has been going on among the central banks. when you look at the survey data among central banks, they continue to say, look, over the next 5 years, we're going to continue buying gold and we're not going to buy the dollar. They're not selling the dollar necessarily, but they're just using capital, putting it into gold instead of the dollar. And here's a look at gold versus the total return of the S&P 500. I included total return because that includes dividends and reinvestments, a little bit more of a fair comparison when you think about gold that does not have any type of dividend. And the ratio chart here is breaking out from a major bottom. We'll call this a secular breakout. If you look at this trend, it would suggest further gold outperformance over stocks. I think a lot of people have been surprised that gold outperformed, I think, in 2023, 2024, and 2025. And that's against a market that has been fueled by technology and AI. And gold is far from that. It's a simple rock, right? And it's still outperforming. Technicals tell you expect the same type of trend to continue this year.
Amazing. Well, Adam, as usual, thank you so much for your time. I do want to say that I think we're in a very interesting time where evidence hasn't really shown us which direction the market will go. And in some ways, the market has been very resilient, and in other ways, it's been breaking down. I think it's important to be patient and watch for that evidence to show you a direction before making any significant moves. And I think you would agree with that, Adam.
Yeah,
Um,
100%.
Overall, there are a lot of uncertainties, and the market does not like uncertainties, right? So a resurgence of inflation potentially could happen. There could be, this oil crisis that we're seeing. It's been fast and furious, and if the Strait of Hormuz doesn't open up or reopen, then that could cause global pressures and global issues when it comes to agriculture as well as commodities. We have a new Fed. We don't know when that's going to come due and when that's going to be appointed, but that appointment should happen sometime this year. And then it's also, a midterm election year. So there's a lot of noise that's going on in the backdrop. And I think it's very important to stay focused, to not let your emotions really get the best of you, and to make the right choices. So I have to finish with some disclosures. Here is our typical disclosures that, again, we're not giving any investment advice, but would be happy to on an individual basis. And if there's any additional questions that I can open it up to, now is a good time. I guess we were so good, Adam. There's no questions. Thank you very much
Covered it
for your
all.
time. Don't forget about March Stock Madness. Very important. Dinner on me if you beat me.
All right.
All right.
That's a good incentive. You got good dinner choices out there. So
100%. And if not, you can come over here if I win, and we can do our next webinar in LA.
sounds good.
All right, have a good one.